Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Mr. Daniel Yu, a global strategist at Yuanta Securities. Mr. Yu, good afternoon. Thank you for making time on this Friday.
Good afternoon.
Well, let's start with the U.S., where stocks pulled back a little ahead of the jobs report due out on Friday. On the S&P 500, not a big decline, but financials, consumer staples, utilities were among the sectors that were lower. Gains for telecoms and health. What's the story in the global markets?
Yes, if you look at the U.S. market, it kind of trade lined. If you look at the S&P, it fell by about 0.2% or so, whereas the NASDAQ rose by about 0.1%, and Dow was down by about 300 points. So pretty much quite a weak session, but not much of a movement. Investors are quite concerned about the speed of the Fed rate hike. We are expecting a slowdown in terms of the pace of the rate hike, but level of the peak level interest rate, we're quite confused about it at the current point in time. If you look at the ISM PMI numbers, it's coming in at 49 in November, which is a first contractionary number since the pandemic level of the problem that we saw 2 years ago. So investors are saying that overall recessionary pressure is continued to be increased. Sentiment continues to be quite poor. And we're waiting for the November job reports. And if you look at the consumer spending, it seems to be quite resilient. So there's a mixed signals coming up from the market, and that people are confused about whether interest rate pace will be faster, would slow down to the extent of where 10-year government bond rates are trading right now. So overall, I think the market will continue to be quite volatile until we see a clear picture of how aggressive the economic recession would be, and also how the resilient the consumer spending would be, and also how the labor market will play out in terms of the inflationary pressures. For the time being, just quite a confusing numbers at the current point in time. Therefore, without that kind of clarity, we think the market will be quite volatile, as we've seen in the past 2 weeks or so.
Well, speaking of confusing numbers, if we could talk about the bond market for a minute, this rather extreme inversion of the yield curve on the 2-year and the 10-year Treasuries. The gap now as big as 78 basis points or so, the most since 1981. But apparently investors don't see that as a sign of impending recession, perhaps like they might have in the past. What do you make of this signal in the bond market?
Right. It's quite confusing on that as well. If you look at the 10-year minus 2-year government bond rate differentials, it's at around 0.8%. Now, 10-year minus 3-month differential also is at around 0.7, 0.8% minus. Both of them are quite a negative territories that we haven't seen since 1980s. Clearly, in the past 5 times of record, both of those differentials turned negative. It tends to get into a recession within the next 16 to 17 months or so. Of course, there are times where it could be faster or it could be later, but in any case, these kind of negative numbers would imply that the economy will fall into recession sometime in the future. The reason why the investors are not too worried at the current point in time is that we think that the inflation pressures are coming down, and that is causing the long end of interest rate to be stabilized, while the short-term interest rate still remains to be quite resiliently high, because the Fed is keep talking about the level of rate. The Fed rate could go up to as high as about 5%. So that's why the short-term rates are well above 4% level, while the long end of interest rates at 3.5%. Right now, we calculate that the U.S.'s fair interest rate 10-year long run will be somewhere around 3.5%. So therefore, it seems that the long-term end seems to imply the current economic conditions, but for the short term, because government is keep talking about, the Fed is keep talking about how they will raise interest rate at high number and remain at that for until the end of next year, that causing that uncertainties. Now, when you have a negative spread, then you would think that the banking sector would probably not lend anymore because deposit costs rises faster than the lending rate. That would create a negative margins. But it seems that because of the long end of interest rate, the risk premium that you imply seems to be quite high. Even 30-year mortgage loan rate, long term, is fixed at around 6.5%. So they are saying that it can create continuous quite a bit of a positive margin. So that's why you are seeing continuation of a huge increase in the lending, where you see YOY number to be around 10% plus. So if that's the case, then the economy is not going to fall into economic recession as the banking sector supports the overall economic growth rate. So I think that it's quite confusing for the time being, but if I have to guess, we think that the short-term rate will be falling gradually rather than long-term interest rate rising faster in the future, given the fact that inflation pressures are coming down and economy is slowing down as we're expecting.
Well, it's a very interesting situation. And here in Korea today, we saw stocks down quite a bit with foreigners selling this time. Shares of Samsung Electronics down sharply, along with those of several of its affiliates. We've seen the exchange rate come down a lot this week, now a little below 1,300. Tell us about the domestic market, Mr. Yu.
Yes, in terms of the correction, it seems to be too severe today. Despite that, most of the market seems to be reasonably resilient. Kospi went down by 1.8%, or quite a big drop. Kospi is also down by 1%. Main reason for this kind of drop is all because of the foreign investors majorly aggressively selling of the Kospi of 400 billion, Kosdaq of about 115 billion, and futures market almost 600 billion. So if you add it all up, more than $1 trillion of the selling pressure coming from foreign investors. We can't see why this is happening unless they're probably targeting the next Thursday's futures options closing day, where the market has recovered quite significantly. So they might be taking a short-term correction or taking profits. If you are seeing in terms of where the sellings are happening, it seems that it went out. Selling happening all across the board, where major large cap stocks all went down, electronics, semiconductors, all sectors have shown a quite significant decline. Particularly the sectors that we were interested in, including the electric vehicles and the parts and battery side, also showed a significant correction. So it seems that quite a bit of a significant profit taking is happening. However, if you look at the overall fundamental basis and in terms of the inflationary numbers and the GDP growth rate, we don't think that Korea will be entering to a major economic recession. We think that it's quite resilient in terms of the export numbers, and also if the oil prices coming down as we have seen, energy prices coming down this much would allow the trade surpluses to turn around. Right now it's in huge deficit, but it can turn to positive territories next year. If that's the case, then we think that the Korean market's correction is going to be quite a short term. It's just a short-term profit-taking move right now, I think.
Got it. All right, Mr. Yu, we'll have to leave it there for today. Thank you, as always, for coming on the program. Have a great weekend.
Thank you. You too.